Stocks are firming up here as trading commences. The last 20 minutes have been pretty good as equities are now green across the board. Of course, last few weeks have been pretty powerful. Not every stock, though, has ramped up. Zoom Video is still kind of stuck down here. I got Tom White in studio with me. Look at the options in Zoom. And Taz Koujalgi joins us from Wedbush Securities, Managing Director of Equity Research. Taz, thanks for being here on the Schwab Network this morning.
Sure. Thanks, Oliver. Good morning. Thanks for having us.
So Zoom is the last couple weeks bouncing a little bit, but it wasn't too long ago we were still at the lows for this stock. It doesn't seem like it's very high on the market's list of comeback stories. How can they turn that around?
Well, I think the two revenue streams here that Zoom has. One is the online customers that are smaller, medium customers who buy their Zoom products online through swapping a credit card. Then you have the enterprise customers who sign longer-term contracts who are more bigger, larger customers. The issue with Zoom is that we've had some churn in the smaller online cohort, while the enterprise segment has been fairly stable. I think for the market to get more positive in the story, we have to see that online churn stabilize or come down. So I think that's kind of where the market is stuck right now. Fairly positive on the large customer story, but a little concerning on what happens with the churn in the smaller and the mid-market segment that we've been seeing for the last few quarters. We have seen some stability in the last quarter or so, but I think that's where the market is hoping to see some more growth or some more less decline in the online cohort going forward.
That's interesting because the big customers are oftentimes the one that it seems the earnings are most dependent on. But Zoom certainly has acquired and accumulated, rather, a lot of little guys using it over the last couple of years as well. So I guess that churn rate would have to be pretty high to have that small consumer enough to move the stock more than, I guess, the big ones.
Yeah, I guess if you look at the mix of the big ones and the small ones right now, I think the big ones are slightly more than half the mix. But they drive most of the growth, right? Okay. So the last couple of quarters, we've seen growth coming from the large customers. The smaller customers have been declining, but declining less every quarter, year over year. So once we start that small customer decline stabilize, and then we have the large customer growth continue or even accelerate, because Zoom has announced a lot of new products in the last few quarters. So there's a lot of upsell potential here. We can have these large customers buy the Zoom Phone product, buy Zoom Contact Center. So if the online segment, the small customer segment, stops declining, stabilizes, and the large customer segment keeps growing, that could change the sentiment of the stock.
So then this is pretty interesting because the bear case, it seems like, for Zoom has been the post-COVID kind of withdrawal, not as many people needing to use it as much, going back to the office. So I guess if the small customer churn bottoms out, then does the bear case also end, or is I guess that depends on how sticky those big consumers are?
Yeah, the big customers have been fairly sticky. I mean, Zoom, again, we want to separate the stock from the company, right? The company has been great. It's got good products. The customers love their products. Very sticky, loyal install base. They've been buying more products from Zoom over the last couple of quarters. So the bear case ends when we see that online churn start stabilizing, or basically that segment starts growing again, and then the enterprise, the large customer segment starts buying more products from Zoom. There's no pricing pressure. The competitive landscape becomes a lot more easier. We'll have to see growth come back to the story. I think that's where the bear case is. That growth will remain constrained for quite some time, but I think that bear case will get defeated if the online segment stabilizes, and then Zoom is successful in cross-selling and upselling their additional products to the large customers.
Tell me about the products that are most interesting to you, Taz. I mean, I know they've kind of put some stuff out there, but it seems like the market still views them as a one-trick pony.
Yeah, I mean, Zoom was. It's interesting how Zoom went from their growth just accelerated during the pandemic. So they went from a less than $500 million company to almost $4 billion revenues in about 3 years. So huge inflection in growth there because of COVID, and that has definitely pulled forward some growth. So I guess they'll have to rely more and more on selling more products to their existing install base. And the one that I think is most interesting in the near term is Zoom Phone. They launched Zoom Phone about 3 years ago, and as of last quarter, Zoom Phone is about 10% of revenues now. So that is the most interesting one in terms of upsell potential to the install base. A new product that they launched recently was Zoom Contact Center. if you remember, Zoom tried to buy Five9 about a year ago, and that didn't go through. So Zoom has their own product now to compete in the contact center space. So that's the other product. But Zoom Phone by far, I think, is a lot of upsell potential. It's only about 10% of revenues now, and given the big addressable market in that area, I think that's the next interesting product for Zoom.
Okay. And what might that do to the bottom or top line? Where should that be showing up real quick, Taz?
So it is accretive to both the top line and the bottom line. If you look at the mix, they don't give us the growth breakdown between the different products, but I would assume that majority of the growth today is being driven by the add-on products. And most of the add-on is happening on the large customer segment, not so much in the small customer segment. So whatever growth we're seeing right now, I think will continue with Zoom Phone being the main driver. And if Zoom Contact Center also adds to that growth, we should see the growth in the large customer segment hopefully accelerate as we have more and more customers buying the additional products.
All right. What do you think is achievable in the next 12 months, Taz, for stock price?
Stock is relatively cheaper when we price it on a free cash flow multiple. The company has $6 billion in cash. The other catalyst for Zoom also is they could buy something that's very interesting, which could be another add-on product, which could be another growth driver for the company. And they've been, I guess they've been looking for quite some time. So they have $6 billion in cash. If they buy something interesting, that's another driver for growth for the company. I would say the stock somewhere trades in the low double digits kind of free cash flow multiple. That could go to the teens as growth accelerates. So I could see, you could, just based on the multiple expansion, if growth stabilizes, you could expect about 15-20% upside here to the stock.
Wow. Okay. All right. Thanks for the analysis. Much appreciated, Taz.
Thanks for having us.
Tom, a little bit of a bullish tone there from the analyst.
Yeah, this one, it's always a question going into earnings on this stock, just because their growth rate has been slowing. Taz mentioned $6 billion in cash sitting on the sideline. Free cash flow is really good for this company, so maybe acquisition targets might be in place, as he stated. But option market's pricing in about a plus or minus 8.5% move in the shares, about $5.50 either way. So I look to take advantage of the implied volatility levels in the different option series. For this example, trade using the option market, the near-term implied volatility really elevated going into this. You've got some event risk.
8.5% move. That's betting on a pretty big swing in the market right now.
It is. So I looked at a strategy that takes advantage of some movement, but you just don't have to price it where you think it's going to go. It can go up or down, but you want it to move about that 1 standard deviation. So I looked at a double diagonal spread here where I'm going to go out to the December 1st weekly options. Those expire in 11 days. I'm going to buy a strangle in there. I'm going to buy basically a 74 strike call and a 59 or 56 strike put. So you're buying out of the money call, out of the money put. And then the near term options, which have a higher implied volatility, sell the 71 strike call and the 59 strike put. So in essence, you're creating two out of the money diagonals on this, creating this double diagonal. You're actually collecting a credit of 60 cents on this one, because in the December 1st options that you're buying, that 74 call and 56 put, you're buying about a 74% implied volatility on aggregate. Okay. Then in the near term, you're selling about 108% implied volatility in the November 24th options that you're selling on the 71 call and 59 strike put. $3 wide double diagonal here, collecting a credit of 60 cents. Your break evens near about 56 on the downside, 75 on the upside over the next week and a half here. So the differential between the implied volatilities allow you to collect that credit on the initial trade. Now, as you get closer to expiration in the next 4 days on your short options, you can roll those to the next option series, collecting more credits. That increases potential profitability and increases those break-evens levels that you have here. But this one, you just need a move, Oliver. But even if it stays right where it is, you're still going to profit on this trade, because the initial price on the trade is an actual credit of about 60 cents. So good way to look at it, where you need some movement, but if it doesn't move, you're okay too. You just don't want maybe a 2 or 3 standard deviation move post earnings.
That makes sense to me for this stock to trade, because it really just seldom disappoints in terms of volatility.
Right.
It's always doing something wild. So, all right. Thanks, Tom. Maybe if they tell us something surprisingly good, they can catch up to the market in a hurry and trade makes money to the upside.